Bismillahirrahmanirrahim. Hello everybody. We are going to start our lecture number 16, and that is about economic concept used in project appraisal. What do we mean by project appraisal? Appraisal means selecting or choosing between different alternatives. The study of the alternatives is somewhat called project appraisal in layman's language. Okay, so before we go and have this lecture started, we will start our lecture with the summary of the previous lecture. And the other day we had discussed about a case study of project selection, how we select the project while we are sitting in PMO or with senior management, or how can we choose our project by using a technique that is called as AHP. So then we had discussed project selection case study, then other extended applications of AHP, and like how can we select a supplier or a contractors, or how can we carry out the procurements and stuff like that by using an AHP. And by that time we had discussed all the processes, like how to develop a goal, and then how to have different criterion set to choose among, and then the alternatives from where we have to make a choice from. And then we had discussed about how to develop pairwise comparison matrices for each criteria, and how to carry out how to create normal matrices, normal vectors, and carry out consistency ratios, so that our criterion are very much in line with the standards or out of the PISs. And then overall priority vector was developed at the end, and hence we were able to select one of the project through that system. Okay, so now we start with our new lecture, and that is about economic things or parameters which are used in project appraisal. And as I've told you, the project appraisal is about having different alternatives. Let's say we are having these alternative, there are two alternatives available, and one of the alternative is to construct a road, and another alternative is to construct a high-rise building. So which we will use basing on some economic parameters, and we have talked about economic parameters while we were actually studying this value engineering. Okay, and now we will go into a little bit detail on these parameters. So there are few parameters which are very largely used on complex projects for investment appraisal or project appraisal, and these include but not limited to net present value, internal rate of return, cost benefit ratio, and then some people used to call it benefit cost ratio, BCR, and there are other things like payback period, discount rate cash flow analysis. So all these things will be discussed in this lecture. So we start with the present value concept. Okay, so if you are having this 100 rupees today, so the same 100 may not have that same buying capacity by the end of 1 year. So the money gets depreciated by some rate. Okay, so similarly, few things get appreciated. The price of land usually gets appreciated. The prices of the commodity usually gets appreciated, their prices are increased, whereas the buying capacity of the currency is decreased. So this slide shows how we actually have this thing, and over there you can see, so if we are having this value of, if we are having 100 rupees today, and there is a discount rate of like 10% or interest rate of 10%, so this 100 will become so amount will be like 10% of 100 is 10, and hence total amount by the end of year will be 100 plus 10, and that is 110. Now 110 for year number 2, and 10%, and then 10% of 110 is 11, and then you will have 110 plus 11, 121. And in year 3 you are having 121 at the start of the year, and then you are applying 10%, and then you will have 12.1, and let's say this is 132.1. And for year number 4, 132.1, 10%, and then 13.2. So you are having 13.2 plus 132.1. You are having 146.3. Let's say. So see, with every year, your amount has been increased by a rate, and this is called interest rate. This is the future value, and this is the present value. So the present value of 146.3 by the end of 4th year, which is 146.3. So today's value of that 146.3, which is after 4 years, is 100 rupees. And the present value of 132.1 after 3 years is 100 rupees today. So the future value of 100 rupees after 3 years will be 132.1 rupees. So this is actually been shown in that example. Okay. So if we are having A naught, then present value of A naught is equal to A naught. And A5, so present value of A5 will be A5 divided by 1 plus interest rate and number of year. So through that we may have a formula that is present value is equal to future value divided by 1 plus I and N. And some people used to write R, rate. Okay. So similarly then we are having formula FV is equal to PV and 1 plus R and N. Now R is interest rate, FV is future value, PV is present value, and N is the number of year. So this is the concept of the present value. So these are the formulas we use for present value, for future value, and then this is the explanation of basically different parameters used in this formula. So if we use this formula, future value, and we are having the present value of 100, okay, so future value is equal to 100, and rate is 10%, so 10% is 10 by 100, and year is 3, okay. So we will have 100 times 1.1 power 3, then we will have 132.1. Now that is equal to this thing, okay. So we had calculated with this formula. Or similarly, if we use this formula, this one, okay, so present value is equal to future value, and that is 121, and divided by 1 plus 0.1 and 2. So we are having 121 divided by 1.1, that's power 2, and then present value is 100. So this is what we are doing with the present value and future value. So 1 will be in year 1, and with this discount 12%, okay? So 1 in year 2 will be 0.89, and year 3 0.8. In year 4 that will be left with 0.71. So 1 is actually getting discounted, okay? So interest is actually you increase it, or discount is you decrease it, okay? So 1 in year 5, 1 year 6, 7, 8, 9, and 10 through that very formula, and 1 in 15 and 20. So 1 become 0.12 in 20 years, 0.12 in year 1, okay? So now compounding rate periods are quite, for that thing there are two types of interest, the simple interest and compound interest. So the formula we were using was of the compound interest, but when we are using the concept of one principal amount, and then let's say the principal amount is 100, and then interest is like 10, and then the future value will be principal amount time and plus interest, that is, and hence that will be 100 plus 10. Now that concept is called simple, an example of simple interest. Whereas when it comes to compound interest, so your principal amount is there, then you add the interest into the principal amount after 1 year, or whatever the period you have chosen, then you actually start the next year with the principal amount plus interest, and then you apply the interest rate end of the year, and then you get the modified principal amount at the start of the third year, and then you apply the interest, and then so by this fashion you are doing the compounding, and this was an example of the compounding over there we had. This is an example of the compounding over there, okay? So interest may be compounded over periods other than a year. In terms of bank account examples, this simply means that interest is credited to the account more frequently than once a year. So now we will have a few examples, or the concept. After going through this concept, we will have better understanding of the compounding, okay? So let M denote the number of compounding intervals per year, like 4, 3, 2, 1. So 1 means you are compounding annually, or 2 means you are compounding biannually, and by 4 you mean quarterly, okay? And by 12 you mean monthly, okay? So N the number of years, and R be the stated annual rate of the interest, okay? So the relation between present and future values is then stated as Fn is FV, future value of n, and that is the number of years, and PV is present value, R is rate, and M is the number of compounding intervals per year, like 4 for quarterly compounding, or 2 for biannually, or 12 for monthly, okay? So N is again the number of years, and M is the interval. So okay, so if we are having PV of 1000 and rate of interest is 0.12, and M is equal to 1 interval, and that is 1, like annually, and then future value for 2 years will be in that formula. If we put future value for 2 second year, after second year will be 1000 plus 1.12 times the power 2 into 1, and that becomes 1254.40. So your 1000 will be 1254.4 after 2 years, right? If you go for compounding after 1 year, okay? So while if you go for 4 compounding intervals like quarterly compounding, then FV2 future value after 2 years will be 1000 is the present value, and now by putting these R 0.12 12% का इंटरेस्ट है, और M इज कंपाउंडिंग इंटरवल्स जो कि आपके 4 हैं क्योंकि आपने क्वार्टर लिया है, सो 4 और 2 मल्टीप्लाइड बाय 4. सो by calculating all these you come across with the figure of 1266.77. Now see, there is a difference between these two. So this is future value and this is future value as well. Okay, so this is future value by having this is for annual compounding, and this is quarterly compounding. So see, there is a difference of like 166.77 and 1254.40 and 7321. So 12.37 is the difference between the annually compounded and quarterly compounded methods. So this is a new thing. This so you should also consider when you go for a simple project, you may have compounding interval for 1 year, but when you come to complex projects where huge investments are involved, then you have to actually decide about the compounding intervals as well, so that you can have a better decision over there. And now we will go through few of the examples, and let's say the first example is find the PV of 500 to be received in 5 years with 12% stated annual rate, annual compounding. Okay, so we are having this PV formula is equal to FV and divided by 1 plus R and N. So by putting these values, so 500 is future value to be received in 5 years. Okay, so N is 5, so FV is equal to 500 and N is equal to 5 and R is equal to 12% or 12 by 100 or 0.12. So you put all these values in this formula and then you get 283.71. Okay, so the present value of 500 after 5 years will be 283.71 if you go for the annual compounding. And if you go for biannually or semi-annually, then you will use this formula. Present value is equal to future value and 1 plus R per N. Okay, let's check it out. Okay, and sorry, M, and then N times M. Okay, so M is the compounding interval, and for this very problem we are having 2 compounding intervals. So M is equal to 2 for this very problem, and N is equal to again 5 years, and FV is 500 and R is 12%. Okay, so then present value becomes 279.20. Okay, and similarly there is a third example, and that is if we go for the quarterly compounding, 12% stated annual rate, and for this M is equal to 4 and N is equal to 5 and FV is equal to 500. and R is again 12%, right? So you get, by putting these values in this formula, and hence you are having these calculations, then you get 276.84 of the present value of that very 500. So see, so you are having different values for present PV for 500 if you have the same very interest rate, but the compounding intervals are different. For first example, we were having one interval, and for the second thing we were having 2 intervals, and for the third we were having 4 intervals. So compounding intervals were different in 3 examples. So we were having different PVs, and you can see over there 283 to 276. So when you make some economic or financial decisions, you should be very careful, and then you have not only to decide what is the interest rate, rather you also should have decided about the compounding intervals as well, as this can actually reflect into your cash flows. So there is explanation of the example we had carried out. Notice that the use of more frequent compounding acts as if to increases the stated interest rate. The effective annual rate is very good concept, and that is effective annual rate is the annual interest that would produce the same answer with annual compounding as is to obtain with more frequent compounding. It can be obtained by this formula. Effective annual rate, that is R is the rate and M is the number of compounding, and minus 1. So if R is 0.12, 12%, and M is 4, then EAR is 1.03, and if you put these values in this formula, then we are having 0.125 or equal to 12.55% interest. So when you are using that interest rate, then if you are going for the 4 quarterly compounding, the answer will be same. So the effective annual rate is the rate that if you earned it for a year with annual compounding, you would end up with the same amount of money as you would have under more frequent compounding. So this effective annual rate is used for that very purpose. Okay, now we will go through the example of effective annual rate, and a bank quotes mortgage rate of 8%. Now that is called the stated interest rate or annual rate. But will it compute monthly loan payments using standard time value formula? This implies monthly compounding. What is the effective annual interest rate on the loan? So they are saying 8%, but EAR is stating something else. So we are having formula of EAR, and that is 1 plus R by M and power to M minus 1. So if we put these values 8%, and so we are having 12 intervals, so we put 12 and power is 12 minus 1, and then we get this answer, and that is equal to 8.3%. So the bank is saying that okay, so you will be cost, your cost will be 8% of the money, but actually effectively your money is costing you 8.3%. Now this is a very good concept. Okay, so and another example is like if a bank quotes a rate of 8% but will compound interest quarterly, what is the effective annual interest rate? And if we put 4 instead of 12 monthly, you are going for the quarterly compounding, not the monthly compounding. So then you will be having 4 over there, rather 12. Okay, so then your answer will be 8.24. So your bank is stating that the cost of money will be 8%, but actually it is 8.24%. And if you are doing this semi-annually, or then you are having, what is the effective semi-annual interest rate? Okay, so you are actually going for that, and then that is like the interest rate for half the year, and that is even 4.04, not even 8% if you actually double it. Okay, so these are few examples how to calculate effective annual rate. So we have talked a little bit about the interest rate concept and the compounding rates. How do we compound the interest rates? And we have talked about effective annual rates. Okay. Now we will move towards present value concept has been discussed, and rate of interest has been discussed. Now we will move towards net present value concept. So NPV or net present value rule is given on that slide, and if the NPV is positive, now this is very simple, the chosen for the chosen discount rate only, okay, then the alternative is acceptable. If the NPV is negative for the chosen discount rate, then the alternative is unacceptable. And if NPV is 0, the chosen discount rate, then the alternative is indifferent to the without project alternative. So through that, we are having project number 1, project number 2, project number 3, and this is 432 minus 30 and 0. So you will select this project because this is a beneficial project, and this project is not beneficial, that is in loss, and this is indifferent. Whether you choose it or not, it won't add any financial value or economic value into your portfolio or your organization's portfolio. Okay. So the net present value and internal rate of return concept, we will talk about. We will have example of net present value as well as internal rate of return. Many people get confused by these two terms, but the concept is very, very simple, and we will show you how simple these are. So when we talk about net present value of a project alternative relative to the without project alternative is the sum of discounted net annual benefits or costs. So here we are talking about net annual benefits or costs. Okay. So if we are having positive more benefits and lesser cost, our net present value will be positive. If we are having more cost than the benefits, so our net present value will be minus, and hence not acceptable. Okay, so what is about internal rate of return? It is nothing else but a discount rate at which net present value becomes 0. So this is a very simple concept. Okay, so before we go to IRR, we will have net present value concept. So this is a very good example, and over there you can see. Now this table is very important as far as learning is concerned. So if you can grasp of this table, very good, then net present value, internal rate of return concepts will be quite okay then. Okay, so let's have, we are having this first project, and the investment or cost, whatever you actually call it, you have actually spent in year, you are planning, okay, we are going to spend 10,000 rupees or dollars, whatever the currency you are using. Okay, so if you are spending 10,000, so this will be the first year cost, and in second year and third year, fourth year, fifth year, you are spending no money. Okay, so by spending this much money in first year, project year, and then for through operations, you are having these benefits in respective years. Let's say you have constructed a store, or you have constructed this multi story building, 2-story, 3-story office building, and this is your construction cost, and these are the rents in respective years. Okay, so these are the profits or benefits. So you can say that, okay, what is the profit for the first year and why this has been decreased, and in the year 4 that has been increased by a few thousands. How can that be happening? So the answer is, for first year you are spending no money in operations and maintenance, and for the second year you have carried out major maintenance, and third year again a major maintenance, and then fifth year you are carrying out some operations but not the maintenance. Okay, so this is, in this fashion you actually calculate the benefits in respective years by calculating the difference between the spendings and benefits by that respective year. Okay, so net benefits are, if you do some maths, and benefits minus cost, now this column is called as B, okay, and this column is called C. So D column, and that is net benefit, is equal to this C minus B. So 0 minus 10,000 is minus 10,000, and 6,500 minus 0, okay, 0, and 3,000 minus 0, 0, and 3,000 minus 0, 0, and 5,000 minus 0, 0. Okay, so, and then you actually sum all these parameters, you come across with 7,500 are the net benefits. Okay, so these are the values which are the present values, future values, like these are future values. Okay, and we want to have decision today, so we want to have present values. So we apply this formula. So present value factor is E is equal to 1 plus 1 plus I power A, and A is 1 over there. So for, if we put the value over there, so the factor is 1 plus I and power A, and hence we will get this. And if we put like 12%, and then we will have a 0.8929, and then 0.7972, 0.711218, and 0.6358. Now multiplying this factor with this gives you minus 10,000. Rather 6,500, we will have 5804, the present value of 6,000, and the present value of this 3,000 after 2 years will be 2,392, and the present value of this 3,000 after 4 year, after the end of the 3 year, that is 2,135, and the value of this 5,000 after the year 4 is 3,178. And now by calculating or by summing up these columns will give you present value. So we were having these net benefits, and now we are having present value, and the summation of all the present values is called net present value. Okay, so 3,508 is net present value. Notice there that this value is positive, so we will accept that thing. Now we want to have IRR. Okay, so this table shows there, if we are having discount rate of 0, net present value will be 7,500. If we are having 3%, then it is 6,326. If we are having 6% discount rate, then 5 to 8%. So where it becomes, the net present value becomes 0, that interest rate is between 27 to 30, and over there that is there is some something that is IRR. So to calculate IRR is quite iterative, and we come across with 29.3%. Now here comes the question. We have discussed about making a decision considering net present value, but we haven't discussed about the criteria on which we go for now when we are having IRR values. How IRR helps us to make a decision. So if the net present value is positive, select it. If net present value is more, select it. Okay, and if net present value is minus, do not select it. Or if that is 0, so that is indifferent. If you select or you do not select the project, okay, then comes IRR. So this IRR is at discount rate of 12%. Your cost and profits are discounted at 12%. So then you are having this 29.3%. So if you subtract that IRR and a discount rate from this, you are having 17.3% surplus. Hence, this project may be chosen. But if your IRR is like 11% and your discount rate is 13%, now that is a loss. Do not select this project who is having lesser IRR. Okay, if you are having 15% IRR or 26% and then 36%, which project is your choice? So your choice should be 50%. So the more IRR at a given discount rate, the more good project or better project it is to be selected. Okay, so okay, now we move further and explain all the discussion we have by this point in time, and we will explain internal rate of return. So over there you can see this is net present value and this is discount rate. So if your discount rate is increasing, then your net present value is getting lowered. Okay, so so this is your net present value at this discount rate, and this is at this discount rate, and then over there. And there comes a point over there, right? Over there, where your net present value becomes 0. Okay, so this discount rate is called as IRR, internal rate of return. So before you can actually calculate your internal rate of return, you have to decide about the discount rate at which you are actually discounting your cash flows and benefits and costs, and then you have to clearly and objectively calculate the costs. And you remember we had calculated the cost in one of our sessions, and that is estimate cost. Okay, and then you should have the benefits as well, and what would be the benefits, and then you convert those benefits to present values, and the summation of all the present values throughout the life cycle of the product, you have net present value. So the positive is the NPV, you will select it. Negative, you will reject it. 0, it is indifferent if you select it or not. And more IRR at particular discount rate, so that is the choice for the selection. Another parameter which is been used for project selection as far as economic analysis or financial analysis is concerned, and that is called benefit cost ratio. So if you are having two alternatives, and this is alternative number 1 and this is alternative number 2, and the BCR, benefit cost ratio, is benefits over cost. So if that is greater than or equal to 1, then that is good. So one project is having benefit cost ratio of let's say 1.2, other is having 1.3, and other is having 0.9. Which project you will use or choose? Okay, so if you are choosing 1.3, remember there is a difference between cost benefit ratio and benefit cost ratio, and we use benefit cost ratio to be inconsistent with other very good practices. So 1.3 BCR is good one, so you select your project based on this. So this is the third parameter on which you select your project. Okay, before we move further and explain benefit cost ratio a little bit more, let me explain there are two types of analysis, and that is financial analysis and economic analysis. So when it comes to IRR, that may be economic internal rate of return and the financial internal rate of return. Now there is a difference. I suggest you people to go and Google the difference between both. Okay, so now I will explain a benefit cost ratio for this. Okay, alternative number 1, we are having this much cost like 10 and benefit is like 15. So BCR for alt 1, alt A is equal to benefits are 15 by 10, so 1.5. Okay, and for alternative number 2, we are having let's say 100. Okay, let's say 100. Okay, and then we are having benefits of like 1.15. So BCR alt P is equal to 115 divided by 100 and 1.15. So alternative number A is more profitable. So benefit cost ratio is high for alternative number A than alternative number B. So for alternative number alternative A, we are having 1.5 BCR, and for alternate B, we are having 1.15. So we will choose which one? As I've told you, we will choose the higher value, and that is so if we have to choose between alternative B and alternative A, we will choose alternative A for this very particular example. Okay, then this was about benefit versus cost, and then there is a term net benefits versus cost. Okay, so and that is, you know, net benefits, I mean net present value. Okay, so if we are having this same equation, and let's say this is it, and then this is a rough line. Okay, so we are 100 and 100. Let's say this is 100. Okay, so okay, and then this is like 7. So let's have a similar type of analysis, and that's 6 point, let's say 3 benefits, and then divided by 10 for 1A, and for B the ratio is 7 divided by 100. So we are having 0.63, and this is for 0.07. Okay, so as far as project A is concerned, that is selected. As for a B, it is not selected. Okay, so another very good analysis available with us is marginal contribution concept. And remember, we had this concept. If you produce more things, the fixed cost remains the same, the variable cost gets increased, but the per unit cost decreases because of increase in production. But there comes a level where both gets where maximum benefits are achieved, and that point is called what? We are going to explain. But before we go to that, we will have this concept of marginal contribution. So marginal contribution means fixed cost plus profit. Okay, there is an example or case study over there. Direct material cost. We remember we had this thing: direct material, direct labor cost, and then variable overhead costs in value engineering lectures. Okay, so from there, let's say direct material cost is 5,000. And labor costs are, let's say, 1,500, and then variable overhead costs are like 500. So marginal cost is the summation of all the costs, like direct labor, direct material, and variable overheads. Okay, so 7,000 is the, so summation of these is 7,000, and that is marginal cost. उसके बाद अज्यूम ये करें कि जो आपको रेवेन्यूज मिले हैं, जो आपने चीज़ें सेल की और उसकी वजह से जो आपको लाइक आपने 100 चीज़ें सेल की और एक चीज़ की कीमत जो है, यहाँ 100 आइटम्स आपने सेल किए और एक आइटम जो है वो 700 रुपये की थी, सॉरी 100 रुपये की थी, तो फिर आपकी जो टोटल रेवेन्यूज आ गए वो कितने थे? 10,000 रुपीज़. सो ये आपके टोटल रेवेन्यूज आ गए. और अगर आप इसमें से रेवेन्यूज में से कॉस्ट, मार्जिनल कॉस्ट निकालें तो यू विल गेट 3,000. ओके, एंड देन योर फिक्स्ड कॉस्ट इज 3,000 and hence profit is nil. Okay, we can do another example. Okay, so we are having another example. Let's say we are having this direct material cost is 6,000 and direct labor cost is like 2,000 and variable cost is 1,000, and hence our marginal costs are 6, 8, and 9,000. And sales revenues, by that time, our sales revenues are like 15,000, and hence marginal contribution is 15,000 minus 9,000, 6,000, and fixed cost is the same, 3,000. Hence we are having a profit of 3,000. And now we take another example, and that is 4,000, 3,000, and 1,000, and 300, and hence we are having marginal cost equivalent to 4,000 and 300, and then sales revenues are, let's say, 7,000, and then marginal contribution is 7,000 minus 4,300, and that is 2,700. Okay, and the fixed cost is 3,000, that is fixed. Hence your profit is minus 300, or if you are writing in accounting, then you put bracket around. So see, according to this concept, if you are having direct material cost is, is directly is very much related to the production of something. So by using this concept, you can actually identify what is the level of the production you have to keep to avoid the loss, and what should be the level where your profits are starting to build up. Okay. So this is the concept of marginal contribution, and based on these this analysis, you may have this analysis, break-even analysis. Okay, so what is break-even analysis? So by increasing the variable cost, because over there with the more production you are having, the variable cost will be getting increased. Okay, and then fixed cost will remain the same. Okay, and then there is a sales line. So sales line, the sales will be increased, and there come a point where now this is the point in cost and this is a point in production, volume of production. If you produce more products after that, that will actually increase the cost, but that will add no profit. So this is the point where you are having zero profit, and before that point over there, this area, if you are over there, then you know you are having loss, and above that, under that part, you are having profit, and if you go over there, then you know there is again you have to reconsider the option. So break-even analysis lets you know what should be the volume of the product where you get you start getting the profit, or where is the point where you actually avoid the loss. Okay, now there is another parameter that has been used for decision making, and that is a very good parameter that is called payback period. So in order to choose an alternative, this method can be employed as well. This is an easy method and can be easily assimilated. This will show how much time a proposal will take to pay back its cost. However, following are the limitations. There are few limitations. In this method, lives of the alternatives are not considered. So life cycle costing, when we are talking about life cycle costing, hence this method will not be used for that analysis. This may be used for financial proposals or stuff like that. And that time value of money is ignored in these methods as well. So the principles on which payback period analysis is actually based, only one, कि मेरा ये सारा पैसा जो मैं इन्वेस्ट कर रहा हूँ ये कितनी देर में मुझे वापस मिल जाएगा. How fast can I recover my initial investment? Method based on cumulative cash flows and screening guidelines. If the payback period is less than or equal to some specified payback period, the project would be considered for further analysis. आपने कहा कि मुझे आपकी कंपनी का एक पॉलिसी है कि मैं एक ऐसा प्रोजेक्ट करूंगा, ये करूंगी जो कि 3 साल में मुझे पे बैक दे दे. एक ऐसा प्रोजेक्ट आ गया जो 7 साल में पे बैक करता है. यू विल नॉट कंसिडर इट फॉर फर्दर एनालिसिस. और अगर आपकी कंपनी में पॉलिसी है कि आप 4 साल का पे बैक पीरियड रख सकते हैं और आपके पास ऐसा प्रोजेक्ट आ गया जो कि 2 साल में अपना पे बैक कर रहा है, तो यू विल सिलेक्ट इट. ओके, so does not the weakness of that is it does not consider the time value of money, and that this is a limitation. Okay, so that is based on cumulated cash flows. So let's have this in a very good example over there. So if you can see over there, this is the invested amount you have invested in year 0. Okay. And after completing or acquiring the project, and then you are actually into the operation, then first benefit you come across after 1 year you have accumulated, and that is after 1 year $15,000, and after 2 years you are having $25, and after 3 years you are having $35,000, year 4 $45, and year 5 $45. And in year 6 $35,000. Okay, so if you are actually taking this 85,000 and then you actually add this is minus and this is positive, because this is inflow and this is outflow. Okay, so 85 minus 15 and that becomes 80 and 70,000. So you put 1 over there, that is minus 70, and then sorry, this is 85 and this is minus 70, and this minus 70, this is kind of minus 70 plus 25, that is minus 55 45. Okay, then So when we are having accumulated figures and then we place this 85 and then we were having 70,000 over there and 45,000 over there, and then we were having minus 10,000 over there, and then it become, and then we draw a line, okay? So that is the trend line, and this dotted line is a trend line, okay? There comes a point where your loss or your investment has been recovered. That is point somewhere over there. So you can have 3.2 years through this chart. That is the payback period for your project, this project, okay? And then there is a concept of discounted payback period. The principle is again the same. How fast I can recover my initial investment plus interest. Now this is a good concept, and method is based on cumulative discounted cash flows, and for a simple payback period that was not discounted cash flows, that was based on a cumulative cash flows, okay? And screening guidelines, if the discounted payback period that is called DPP is less than or equal to some specified payback period, the project would be considered for further analysis. And weakness cash flows occurring after DPP are ignored, okay? So this is a very important part. So let's say we are having the same example of the cash flows, and for year 1 we are having minus 85,000, 15,000, 25, 35, 45, 45, and 35,000. These are inflows and these are outflows. Cost of funds is like 15% interest rate. Then we are having 0 for the first year, and then 85,000 times 0.15 and 12,750. So cumulative is 85,000 plus 0, 85, and then we are having 85 minus plus 15 minus 12, we are having minus 82,750. Now we are having minus 82,750 plus 25 minus 12,413, and then we are having minus 70,163. In similar fashion, we complete this column, and then we are having this point where we are having positive, or where we have started getting the benefit. Now this thing is called, if we actually draw this table over there and this point over there, and that is somewhere 4.2 or 4.3. And remember, if we were doing the discount rate analysis for simple payback period, payback time was 3.2 years, and for discounted payback period we were having 4.2. So 1 year is there. The difference of 1 year is there. So this is the difference between payback period analysis and discounted payback period analysis. And another concept that is been used for economic analysis, and that is return on investment. And this index is very useful to convince the approval authority that the alternative proposed by the value engineering team or project management team is feasible from the financial point of view. The mathematical formula for the return on investment, ROI, is given by annual cash flows inflows divided by investment cash outflows. So if you are having annual cash inflows like 200 and you are having investment cash outflows 100, then you are having this value of like 2. So that is positive, that is greater than 1, hence that is a good thing. So then there is an example. Okay, let's say we are having proposal number 1A and proposal number B, and total investment cash outflows are 1 lakh for proposal number 1, whereas outflows are 150, and cash inflows are same, 1 lakh, and there are cash inflows of 3 lakhs. So life is 10 years and life is 15 years for the second proposal. So annual return is given over there. 10, and that is 10,000, whereas for proposal B, that is 20,000. So return on investment is 10% and return on investment is 13.33%. So decision is alternative B is preferable. Okay, so this example shows how to use another parameter, and that is return on investment. If you are having more return on investment, then you are choosing that alternative. Okay. And another financial parameter which is being used by the managers, and that is discounted cash flows. So in this method, all the monetary values of all the alternatives are brought back to present value. Then the difference of money inflow and money outflow is calculated. The proposal whose money value thus arrived at is the highest is the choice for selection. So there is an example assuming 15% discount rate. Examine the profitability of two proposals. Okay, so if these are inflows or investments, so you can take this thing and and these are the profits or benefits, and hence total cash flows you can see by adding all up you are having 192 and 195. So we are having discount factor concept with us. So at 15% we are having discount factor of after year 1.86 96 and 0.75 61 0.65 75 0.5718 and 0.4972 after year 5. Okay, so if we apply these discount rates to our inflows, cash inflows, then we come across with these discounted cash flows, inflows, and then we are having these discounted cash flows for proposal number 2. So then total is 126,525 for proposal number 1 and 125,178 for proposal number 2. Less investment because this is expenditure, so we are having surplus investment 26,525 and 25,178. So this one is higher, so we will select proposal number 1 for this type of data, and hence this method is used for selection of the project. Okay, so we have come to the end of this lecture. You have seen how different economic concepts can be applicable to complex projects. These all parameters are not used even for simple projects, and if they are being used, they are not used in great detail like compounding concept, compounding periods concept. But for complex projects, we are using all these, or even more than those, and the detail at which we are carrying out our decisions are huge. Okay, so we have considered the present value concept, and net present value is the summation of the net benefits, and then the positive is the net present value we are choosing, negative we are not choosing, and zero net present value means that is indifferent. Okay, then we had discussed about compounding periods, how compounding periods actually affect the present value or future values. And then we had discussed about internal rate of return. There may be financial internal rate of return or economic internal rate of return, but the more internal rate of return than the discounted rate, the more profitable or feasible the project is as far as economic parameters or financial parameters are concerned. Then payback period, we had discussed about simple payback period concept and then discounted payback period concept, then break-even analysis, and in the last but not the least, discounted cash flows, and we had substantiated our theory knowledge with so many case studies and examples in this very session. So this is it. I say thank you, good luck, and Allah Hafiz.